Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management Firm. That's the investment firm, Wilsey Asset Management. Great to have you here with us. We got a lot of things to talk about. We got great companies to go over, help educate you more on how to invest using fundamental analysis. Also, too, some important things in the news to help you become a smarter investor, and also many times just smarter with economics and finance and investing and being just knowledgeable. And why I'm talking about that is that the first thing is well, why is automobile insurance so high? You might think, oh, I know why. You probably don't. We'll explain to you. Also, too, 2025 trade deficit. It looks deceiving. People said, oh, the tariffs didn't help at all. It was only down like $3 billion. It didn't help at all. We'll explain what's going on behind the scenes there. And then also, too, these massive AI deals, well, they look concerning. We'll dive into that for you and explain why they're concerning to us and what we're seeing. On the accounting side, I'll say it's kind of crazy when you look at it.
Accounting is not important until it is.
Good way to say it. Good way to say it.
But companies we're going to look at, speaking of accounting, we want to understand the fundamentals of the businesses we're buying. So we're going to look here at Vulcan Materials, Leidos Packaging Corporation of America, and lastly, a fun one here, Caesars Entertainment. As always, we'll give you an idea on the valuation ratios, the balance sheet, and importantly, give you an idea if we think it's a buy, sell, or hold.
And Leidos, that's the defense contractor, right? Is that what they do?
I mean, they're kind of defense. If you go to the airport, right? They do the little scanning machines that you walk through. So kind of airport security. But you can call it
San Diego
defense.
company, I think.
Maybe. Yeah. I don't know. We'll look at it when it comes up.
Well, let's talk about why automobile insurance is so high. Your first thought is, well, maybe the insurance companies are kind of gouging their customers just to make big profits. Well, first off, insurance companies are generally public companies that have shareholders who would not be investing in their company if it was losing money and not paying dividends. These are profitable companies. They have to make a profit. They're not charities. They have to make that profit. The high cost of premiums is not the insurance company's fault, as in recent years, things have really changed.
And one thing I always look at with insurance companies, we actually own an insurance company, technically two insurance companies in our portfolio, different types of insurance. Yeah. The old saying, if you can't beat them, join them. Hey, good businesses to own, I think, in the long term. And as I said, the big thing you have to understand, companies have to make money at the end of the day. If they were losing money, they'll go out of business. So profits necessarily aren't always bad things. But you talk about the change over the last 5 years, physical damage costs have increased by 47%. You have to realize here, there's a higher price of cars, and then all the extra bells and whistles that add up when there's damage to a vehicle. When you look at all the new chips and all the technology that is in there,
sensors,
it is just crazy how expensive things have gotten when it comes to repairing those vehicles. And this is the big one in my mind that I think should be able to be resolved easier. But bodily injury claims are up 52% over the last 5 years because of the vast amount of new personal injury lawyers who really have kind of come on in the scene and are pushing for higher settlements, even on, this one gets me, small fender benders. I'm sorry, you get hit in the car and, things are a little bit, why do you deserve to, and this is, maybe a little bit outlandish, but why do you deserve to get paid $100,000 for I'm a little uncomfortable?
Yeah, and you see the dent, it wasn't really worth it. But we'll talk more about that. But the other thing, too, that the personal injury lawyers, I forget what year it was, but it could be 10, 15 years, I'm not sure, they couldn't advertise. Now that's all they do. They advertise, we'll get you more money. You deserve it. You deserve that. And people go, and again, I'm sorry, some people aren't very honest. And, around 95% of these cases are settled and do not go to court. I mean, many of your less reputable attorneys, and they're out there, know this. And what they do, they hold the insurance company hostage. Either settle us now or go to court and spend a lot more money, a lot more of your time. Better off you give us, $100,000 now than fight and maybe win, but it'll cost you $200,000 to fight us. So that's what they do. And unfortunately, here's another thing too. If you're a responsible driver that makes your premium payments, you're helping absorb the cost. This one gets me. I didn't know it was this bad, of uninsured, and not just uninsured, but underinsured motorists which is up 72%. There's people out there like, I'm not going to have insurance. I'll get the minimum that I can. And then what happens? The person that is paying their premiums, they're absorbing the cost on higher premiums for these people that are uninsured.
And I think you kind of talk about the advertising of attorneys here, and I think I get a small fender bender, right? My first thought isn't to call an attorney. I'm like, oh well, shoot, that sucks. Maybe it's a few $1,000s. I just got to have my insurance settle up with it.
Right.
But the problem is, I think now people get in these small fender benders and like, oh, I heard, Joe Smith, he got a lot of money I'm just going to call an attorney and see what happens. And it creates this whole scheme almost of people making money off of getting in accidents.
Yeah.
And it just has, I think, overcomplicated the system. And I think it's caused a lot of problems. And the downside is there's some times where, I've heard of people, I can't necessarily say exactly who it is, but I have an acquaintance that they got in a car accident. They got life flighted. They got hit by a drunk driver because it was that bad. Yeah, you deserve some payout there. You were in the hospital. You broke your femur. That's awful. Like, yeah, you had to displace that earned income and issues that arose from that. But again, a small fender bender that doesn't change your life at all, you shouldn't get paid for that.
And I know somebody else as well that's on the other side that they were being sued. And they took a picture of the accident, and it was a dent. I don't think it was even 3 inches long. The guy was claiming, I have neck injury now, and I can't work any longer. And an attorney picked it up to do it. And it's just like, it's crazy that people see it as just like money from the sky, and it is not. It increases the premiums of the insurance companies.
Yeah, and the thing I look at is, I think you and I both, we're not big on government regulation, but I do believe this is an area where government should step in and frankly, verified that all people on the road have auto insurance, and also to a reasonable amount to make sure they can cover these, so you're not left kind of to cover that burden. There is a trend starting in Florida, which is tort reform that has reduced litigation, and the top 5 insurance companies in the state have now requested rate reductions of 5.9%.
Isn't that nice to hear that they're asking for rate reductions? Because again, if they're paying out less, they can reduce the rates, but you do all these crazy things. And there is something in the auto industry called fender bender litigation. And this tort reform we're talking about would definitely help states like New York, our state here, California, and other states to prevent insurance companies from having to pay ridiculous settlements for little dings and dents. And hate to say it, fake injuries. People do fake their injuries now. But wouldn't it be nice if the state of California passed laws to help our consumers to pay lesser insurance? They're so like, oh, we're going to get the insurance companies going to make them reduce their rates. Well, no, don't make them reduce their rates. Make it so they can reduce their rates by enforcing this tort reform, so people can't sue for a little fender bender and cost these insurance companies, millions and millions of dollars.
Makes sense.
It does. Maybe that's why it won't pass, because it makes sense. Sometimes government doesn't
we just demonize capitalism and companies so much that they just don't want insurance companies to win at all.
And what's so funny, Chase, is who invests in insurance? I mean, pension plans are a huge investor in insurance companies. It is a great place to be because they have, I don't say their profits are built in, but it is easy to figure out, like, okay, this is going to be our losses, this will be our gains, so they can do that. But when you throw in this extra loop now to where you can be sued for a little fender bender and have to spend $100,000 on a settlement because it costs you $200,000 to fight it, it just throws everything into a loop there. Yeah. So let's talk about the trade deficit, because the 2025 trade deficit, well, it does look deceiving. Some people are saying that the tariffs didn't work because the trade deficit in 2025 only fell to about $901.5 billion from just under $903 billion in 2024. However, if you break down the numbers, which we love doing, quarter by quarter, it tells a different story. Now, the first 3 months of the year, there was a $400 billion trade deficit, but then each quarter after that, it began to decline. In the second quarter, it fell drastically, cut in half, to $180 billion in the second quarter trade deficit.
And there wasn't much change in the third quarter, with a slight drop to $175 billion. But then in Q4, there was a drop to $145 billion. We try to explain to people that the U.S. economy at $31.5 trillion is like a big ship in the ocean. You can't turn it quickly. It's not like a little speedboat, right? Or a jet ski is maybe a better example where you can whip that thing around. These massive ships, they take a long time to get kind of turning there. If people would be patient, I do think, and I'm going to say, I think we would have seen by the end of 2026. There would be further progress, and I believe it's possible the trade deficit could see a decline to somewhere around $600 to $700 billion based on the fourth quarter of 2025 and the data that we got there.
And again, we're not just pulling out of the head. It's just common sense. You can see it declining. You can see it start working. And Chase, as you said, it takes a long time to turn things around. And unfortunately, people just too doggone impatient, saying, well, it's been 6 months, nothing's happened. Like, it makes no sense
I do
to me.
think, this is where you and I might disagree. I don't know if the 145 was a little bit generous, because I think it was just so hard to see, frankly, how much the tariffs impacted. Because when they were announced, you had this huge influx of imports, and it totally distorted it. And then you had companies that were working through that inventory throughout the year. And I don't know if necessarily we'd be at a run rate for the full year in 2026 at, what was it, $145 billion for Q4. But I definitely think it would have been lower this year than it was in 2025. But again, it takes time to work through these things, not, as you said, 6 months. So it's I'm not going to say necessarily my opinion if I think it's right or wrong on the tariffs, but I think using this as an example of they did or did not work is a poor way to evaluate it.
Yeah, and again, it takes time. And again, the 145 could be a low number, and that's why we said for the estimate for the rest of 2026 would be 600, maybe 700 billion. They're not going to go away. You're going to have that trade deficit, but it can be reduced. And what happens when you do that is that hopefully more manufacturing is done here in the U.S. to create more jobs here, and the use of AI is going to help as well. So there's many benefits to that. We're not going to see a trade surplus, I don't think, anytime soon. But to reduce that deficit is a huge thing, because we keep sending our money overseas. And I do know there's a snafu with the Supreme Court ruling that the International Emergency Economic Powers Act, which was first used in the first quarter last year to implement many of the tariffs, was ruled illegal. Well, but there are other ways to impose tariffs, such as Section 122 of the Trade Act of 1974 or Section 301 of the Trade Act that the president used in his first term, also available in the Section 232 of the Trade Expansion Act of 1962. I mean, there's other things that can be done for tariffs.
Yeah, and again, I don't want to necessarily... Tariffs are, in my mind, a complicated situation. So, I'm not going to say I'm pro or anti-tariff. I'm pro free trade long term, but if other companies aren't playing by free trade, well, you got to try and make them play free trade. But I will say I was glad the Supreme Court overturned the tariffs, because it again is sticking to the Supreme Court not being a political body, which I think was an important action that a lot of people were very worried about with the Trump appointees in the Supreme Court. But again, they said, oh, this is the Constitution, these are the rules, and frankly, they stuck by the rules, which I thought was a good thing for this country. But with that said, I don't believe the Supreme Court ruling will ultimately lead to an end of tariffs, as the administration will look at these other avenues that you discussed. And I got to say, one other positive from these tariffs, was it got us talking to other countries and negotiating with other countries about, hey, let's do more trade, let's have you invest more in the country. Ultimately, that is good to have those discussions, in my mind, in the long term.
And actually, one thing I looked at was I think it's a Trade Act of 1974. The whole thing's like 300 pages. You said they're confusing. They're very confusing. That's why it's not just a one-page thing. And that's one. You got the 1974. You got the Expansion Act of 1962. There's subsections. It's a very complicated thing. So there's other things that can be done, and things can change. But again, they are helpful until we get that free trade. So that's what we're kind of working for there. Lastly, and this is something we kind of talked about AI last week, but we got to talk more about that, because people think, oh, it's great and so forth. Oh, on the other side, oh, it's terrible, it's terrible. Yeah. But these massive AI deals look concerning. The number are exciting when companies like Meta or OpenAI announce will be purchasing billions of dollars in chips or compute power from companies like Nvidia or AMD. But there always seems to be a catch. Most recently, Meta announced and it entered into a multi-year deal with AMD to deploy up to 6 gigawatts of the company's graphic processing units for artificial intelligence data centers, and includes use of AI-optimized central processing units, also known as CPUs.
And the deal comes a week after Meta committed to using millions of NVIDIA's processors to power its AI expansion. While I do have my concerns with all the money Meta is spending, my bigger concern with this particular AMD deal is the use of stock warrants. Full details for the deal weren't announced, but we did see the deal includes a performance-based warrant for Meta to acquire 160 million AMD shares, which amounts to about 10% of the company.
And and these things, we'll talk a little bit more about it, but these things are done, and people are like, wow, this is great because they hear the billions.
Yeah.
They don't understand the accounting behind it and what these companies are really doing. The first tranche vests when the first gigawatt of Instinct GPUs are shipped. Other tranches vest as Meta makes purchases up to 6 gigawatts. Vesting is also tied to stock price thresholds for AMD and technical and commercial milestones for Meta. AMD also struck a similar deal with OpenAI, where they received warrants to acquire 160 million shares of AMD, and it was tied to deploy and stock price benchmarks. Another thing, deployment of the stock, and they're playing with phony money, kind of like is what they're doing.
Yeah, and again, I mentioned the 160 million. You mentioned the 160 million. So again, that's about 10% of the company, 10% of the company. So then ultimately, Meta and OpenAI could, in theory, own up to 20% of AMD at the end of the day. And the reason this is concerning is because of the potential dilution, and again, the circular nature of these deals. Essentially, what these companies are saying is, hey, spend $30 billion buying our products, and we will give you $30 billion in stock warrants back.
Can you repeat that? Because I don't think people are going to get it. I mean, it sounds so ludicrous.
Yeah. So again, what these companies are doing is Meta might be buying $30 billion worth of chips, right? That sounds great. Wow, that's great for AMD. But they're getting on the back end $30 billion worth of stock warrants. And I oversimplified this to make it dollar for dollar. It may not work out that way. But incrementally, AMD is not getting $30 billion of straight revenue benefit here. They're having to give up quite a lot to get that revenue.
And we won't get too deep in the accounting, but the accounting, it's kind of trick because they're going to show $30 billion of revenue.
Yeah.
But you're not going to see the other side unless you know how to read the financial statements.
Well, kind of to that point, give me an idea, what is a stock warrant? Well, it gives holders the right but not the obligation to buy or sell shares at specific strike price or at a specific strike price before an expiration date. If they are exercised, what it does, it creates new stock, which would dilute current shareholders. So kind of to your point there, it's like, yeah, it's creating $30 billion worth of revenue potentially, but now there's 10% more shareholders out there after all these warrants are exercised. So when you look at it that way, well, actually, maybe revenue per share didn't increase at all. Potentially, it could have decreased if the dilution exceeds the revenue. And the crazy thing that just blew my mind is based off what I've seen, the exercise price for these warrants is a penny. So ultimately, I just don't believe this will end well for all players in the space, and I think there's a lot of money that will be lost by investors. Again, I don't know why in the world, if Meta and OpenAI get these warrants for a penny, they will be exercised.
Yeah, they will be exercised.
The stock would have to be less than a penny for them not to exercise that.
Yeah.
I mean, it's craziness.
And if the stock is anywhere it is now, I mean, it's going to be a huge thing for them. And it, as you said, it's going to dilute the earnings per share, which means that you're not going to do as well. And this could be, in my opinion, because I said before, like a year or two ago, oh, well, this is not like the internet boom and bust. This is different. The companies that have cash flow, the companies making money. You start doing crazy stuff like this, you do have a problem with you're starting to play fancy money. This could be the downfall of technology.
Well, and we got a different announcement, and we talked about OpenAI last week on the show, and there was something that came out on Friday that OpenAI did announce the $110 billion funding round, that it did end up valuing them at $730 billion in a pre-money valuation. That was a big jump from its $500 billion valuation in a secondary financing in October. But again, talking about that $110 billion, where did it come from? $50 billion came from Amazon. Oh, by the way, in the same announcement, OpenAI said it is expanding its existing $38 billion agreement with Amazon Web Services by $100 billion over the next 8 years. AWS will also serve as the exclusive third-party cloud distribution provider for OpenAI's enterprise platform Frontier. So again, hey, if you give us $50 billion, we'll give you money back. Nvidia, they also invested $30 billion in OpenAI. Huh. what is OpenAI buying? Oh, chips from Nvidia. Hey, we don't have $30 billion right now. We're only generating, I think it's like $13 billion a year or something like that in revenue right now. So we don't have $30 billion to buy your chips. So, hey, give us $30 billion and then we'll buy your $30 billion. I mean, it's just a crazy kind of scheme when you look at these things. And it may work out in the long term okay. They might all end up being okay. But the value of this stuff is not true value in my mind.
And it's really not. And I think you and I laugh at it. I think people that read financial statements, understand accounting, CPAs and whatever, they're laughing at it. But the small investor, the investor, like, they're not getting in. I think institutional investors will get in because they'll see, like, oh, this is great, but they know they're going to sell out before that, where the little guy's going to be left holding the bag because, like, what happened? I thought they got $30 billion. They don't understand it. And I do believe this is going to be the downfall because we already know that your big tech companies, that they don't have the cash flow they had before. It's dissipating. And we have these things that are mounting. They used to be great cash-generating machines. They're not that any longer.
Well, and I mean, you kind of looked at Nvidia this past week. They reported earnings, right? And, they came out great earnings. I don't want to take anything away. And people might confuse us, right? Nvidia is a great business. They're very technologically advanced. They created a great product. But the question is, what is the value of that at the end of the day? And Nvidia, they report these amazing earnings, lift guidance, beat, everything looks fantastic. The stock still falls 5% on the day. And then Friday, it falls another 4%. What I'm starting to see is, again, investors starting to question, they keep raising these capital expenditures from, again, the hyperscalers, your Metas, your Alphabets, your Amazons, and your I think Microsoft. I'm not sure if I mentioned them already. But anyways, those four main players, they now have, as you said, lost that cash flow. And some of them have flipped to being negative free cash flow. They can't keep that up for 3, 4, 5 years. At some point, this investment cycle is going to end. And when it ends, Nvidia's sales profits, I mean, they could tank 30, 40, 50% if these hyperscalers slow down on the spending.
Yeah, because you're going to say, why are we spending 30, 40 times earnings for these companies when they're really not there? The cash flow is terrible. I mean, it's just, we're kind of giving you a warning, and it doesn't mean on Monday, oh my gosh, all these are going to crash. But I think in 12 to 24 months, you will see a different story because they cannot stay on this current path. And already starting to do funny things to try to make things look better. And that will be the house of cards that collapse. And I did predict the tech boom and bust probably about a year before. I called it a house of cards. I see that happening here because they're trying so hard to grow that revenue, make it look really good. They're playing.
Yeah.
So be careful.
Funny money.
Funny money. Be careful of those. So let's talk about a company here. Let's talk about Leidos. I'm sorry. No, we're going to talk about Vulcan Materials first. I'm sorry. Their symbol is VMC. They're in the building material industry, only about 4% short on the float side, 98% institutional owned. PE ratio starts on the high side. It's 37 versus 24. Price of sales 5.2 versus 1.6. Price to book value 4.7 versus 1.7. Price of cash flow 24.1 versus 12.3. And all these are valuation ratios. You do want them lower than the industry average, and unfortunately, they're not for Vulcan Materials. Even the PEG ratio going forward is a little bit high. It's 3.2. The industry is at 3.1. So not a good start in the valuation ratios. Now, they have done well. I mean, their earnings over the last year are up 22.6%. Industry was down 18.7%. Sales declined by 6.3%. Industry was down 0.7%. So those are two big positives. Another positive, the 5-year earnings share growth estimate by the analysts, 11.2% versus 9.9% for the industry. Now, they do pay a small dividend, 0.7%, using about 23% of their earnings to pay that out. Taking a look at the balance sheet, we do see the balance sheet got a current ratio of 2.2 versus 2, so good liquidity, that's positive. Debt to equity, 0.6 versus 0.5, no problem with the debt to equity. We do see a net profit margin for Vulcan Materials of, 14.2%. About the same as the industry at 14.3. Return on equity is on the low side, 12.8 versus 24.6. These you do want higher. And then return on invested capital is 10 versus 19. Again, could be a problem there. Free cash flow looks okay. $1 billion versus $1.5 billion for the industry. Chase, what do you got going forward?
Just give me an idea of what this company does, and the reason I was kind of interested in it is they did fall last week after reporting some disappointing results. But, this is, again, a construction company, and with the infrastructure kind of build out that we anticipate happening, I thought this would be a benefactor here, but you may have missed the boat. What this company does is they provide, crushed stone, sand, gravel, sand, and other aggregates for use in construction and maintenance of highways, streets, and other public works. They also, too, work in the construction of housing, commercial, industrial, and other non-residential facilities. They use aggregates that are used for ballast and construction and maintenance of railroad tracks. They then also just work in asphalt construction, paving services, and ready-mix concrete. So this, again, would be a great place to kind of be investing if you get it at the right value for an infrastructure build-out. But unfortunately, we look at that current price here of $310 per share. The 52-week range, the low is $215.08 and the high $331.09. So it is near that 52-week high. And also, the big reason I say unfortunately is you go up to December 2027, estimated earnings per share here, $10.92. It gives us a target sell price of $181.27. This thing trades at almost 30 times those future earnings. So definitely not getting a value when we look at Vulcan Materials.
Yeah, and also, too, you're talking about a basic material company, sand, gravel, I think you mentioned, concrete, stuff like that. And we didn't mention about the tariffs, that there is deals where we don't know how many trillions will come out in 2026. Maybe it's only 2-3 trillion. But that's money coming into the economy. That's about 10% of the economy. That will benefit companies. Maybe that's why Vulcan Materials is so high, because they know there's going to be more construction going forward.
I mean, you mentioned that situation, but the other big situation is the data center build out.
Yeah.
I mean, I don't know if you've seen those things, but I got to imagine they use a lot of concrete.
Yeah. Yeah.
Those things are huge.
And there will be a lot of construction going on, which is where you get companies like this that could benefit. But that's what I'm saying. I think it's already baked into the cooking. Maybe we do have a pullback this year in companies like Vulcan Materials. That could be a buying opportunity. But I think you said right now it's not even, a little over half is a target sell price right now of the companies.
Yeah, I mean, it trades at, again, those 30 times. We like to sell out at around 16.6 times those future earnings. So it's pricey. I mean, this is almost one where I wonder, you'd have to wait until there's an economic slowdown and things aren't looking good from the build-out side where you could pick this company up on sale. But right now, definitely not on sale.
Well, I mean, the software companies are down about 50%, some of them. So, I mean, you could see a Vulcan Material trade at 150.
No, it's definitely very possible, but yeah. I think when things are good, obviously, everybody else thinks they're good. You want to be buying things when everybody else thinks things are bad.
Yeah, everybody wants to get in when things are hot and exciting, and it's just like, why would you pay the highest price for something? Why not be patient and wait for things to go on sale? And if you miss the sale, then find something else. Stocks are the only thing that people loved paying higher prices for, as opposed to paying them when on sale.
Yeah, it's a great investment thesis where you buy it and you hope somebody will pay you more for it down the road. And it's just not really going to be a great in the long term if you're always paying high prices for things.
Yeah, I don't see how you're going to make money doing that. And that's why people say, oh, stocks are so risky. Stocks aren't risky. They're risky because you do silly things.
Yeah.
So, well, there's the music. We're going to take a quick break here. When we come back, we do have our CFP, our financial planner, Harrison Johnson, coming up, talking about what is the goal of tax planning. Well, you probably reduce taxes, but I'm sure there's more to it. Stay with us. You listen to the Smart Investing Show with Brent Chase. We'll be right back after this quick break. Alrighty, welcome back to the second half of the Smart Investing Show. With us now, we do a financial planning. For that, we have our CFP, Harrison Johnson, join us. And again, I announced this before we went to break. What is the goal of tax planning? Well, people are going to say, want to save taxes. But there's more to it than that, isn't there?
There's a lot more to it. And this is why I'm talking about it, because the obvious answer to that question is, well, to reduce taxes or maybe even reduce lifetime taxes. But that shouldn't be the focus. But people think it is. And by focusing purely on taxes, in many cases, they make the wrong decisions, accomplishing the wrong goal. So what I mean by that is the goal of tax planning should not be necessarily to reduce your tax bill. The goal of tax planning is to make decisions that will increase your after-tax access to money. So sometimes that means paying some taxes, depending on the situation, if that allows you to have more access to money or access to cash flow. So an example of that is, you want to pay less taxes, earn less money. Well, that means I have less money. Yeah, right. Exactly. So sometimes it's better to have a little bit of income or to have assets. Now, the consequence of that is maybe there's some taxes, but that also means you net out more. So this could be an example of how you invest money. Do you want to put money into a savings account that earns nothing? Well, you pay no taxes, but you also make more money. You could also stop working. If you quit your job, you're going to make less money and you're going to pay less taxes. So the goal isn't, to reduce your tax bill, period. The goal is to do things that will increase how much money you have or how much access you have to to assets and cash flow.
And one thing I look at tax planning, and again, I'm not trying to knock CPAs, but it's so short-sighted. They're just looking at that year as opposed to, well, how's this going to affect me 3, 5, 10 years down the road? This is where I think a good CFP, that's a fee-based financial planner, is better because they don't just look at how we can save taxes this year, but how we can increase your investments, how we can increase your cash flow, and do the best we can on taxes.
Especially since a strategy a lot of CPAs have, or tax professionals might have, is, well, I want to defer income because I want to defer that tax liability. Well, that only helps you if you're deferring that income to a point where you can access it at a lower tax rate in the future. So 401ks are an example of that. You put income into a 401k, so you get a deferral now, but ultimately you're going to have to withdraw that later. That is a good thing if you're in a high tax bracket, you're deferring income in a high tax bracket, you access that at a lower tax bracket later. Because at a 401k, it's all deferred income. It's going to be a tax. It's just a matter of time. So really, we want to make decisions that's going to increase the cash flow. And sometimes that means accelerating income. Sometimes having income now through a Roth conversion or a withdrawal might make sense if you're in a lower tax bracket now. And then by doing so, you can avoid being pushed into a higher bracket later.
And I think it's just so interesting. I mean, nobody is stoked to pay taxes, right? Like, I don't look forward to tax time and looking at how much I paid in taxes last year. That's not something that excites me, but it's the reality.
Doesn't excite anybody.
Yeah, I mean, you're going to pay taxes in the long term. And I think it's just so fortunate because, as you said, Harrison, people, they fixate on that tax bill. And I think so many people, and this is maybe a silly comment, but it is true. Actually look at it and look yourself in the mirror. Some people would rather make a 5% return and not pay taxes than make an 8% after-tax return. Because, oh, now I paid all this in taxes. Great, but you made more money in the long term, and your after-tax benefit was still even greater, even though you paid more taxes.
And that's really what it comes down to. So taking out the emotional side of, gosh, I hate paying taxes, because I do as well. Never met anybody who enjoys paying taxes, whether it's income taxes, property taxes, sales taxes, whatever it is. Taxes are something that we all hate. But again, if we focus on that as a goal, in many cases, it leads us down the wrong path. That's going to also leave us with less money. So tax planning, again, is about understanding, well, what decisions can I make? What types of assets should I be investing in? Because all types of assets create income in different ways. Real estate is different than stocks, different than bonds, different than businesses. Those are all treated differently. The types of accounts that you use, pre-tax, Roth, taxable, educational types of accounts. The account type influences what your tax liability is going to be. The way that you ultimately access that money is different. Whether you are accessing money by selling an asset, whether you are holding an asset that's producing cash flow, whether you are borrowing against an asset, all of those are ways that you're accessing money, but they're taxed in different ways. So the choice of asset, the choice of account, and then the way to access that is really what tax planning is about. And by understanding that as the goal, you'll end up with more after-tax money, which that's what everybody wants.
Yeah, it's kind of like it's just not the taxes. You talk about the cash flow. You talk about the growth in investment. Doing silly things like holding an investment because you don't want to pay the taxes on it. Well, you could have that investment drop 50%, take 10 years to recover it. Having Microsoft back in, 2003 for 15 years, you didn't make any money in the stock. But people didn't sell, so they didn't pay taxes, but they lost so much. The opportunity cost is what they lost of other investments.
Yeah, exactly. So nobody likes taxes, but sometimes that's the right thing to do. Not always. Obviously we don't want to go and pay taxes for the fun of it. But
it is not fun.
It's not fun. It's never fun. But it helps you make the right decision if you know you're doing it deliberately for the right reasons. Yes, I'm paying this tax, but I'm willingly do it. And the result of that is now I have more after-tax cash flow or more after-tax money because of it. That can help you stay away from the emotions and take away the bite of, gosh, I'm paying a lot of taxes.
And that's why I think a fee-based planner is much better than a CPA that's just going to focus on the taxes. You got to look at many different factors.
Well, I mean, it's a good combination, right? Like,
oh yeah, you can't get away from the CPA.
CFP is not going to file the taxes.
No.
Or a CFP, I'm sorry.
They should work together.
Exactly. Yeah.
Yeah. But ultimately, I mean, in many cases, the tax side and the investing side are at odds with each other. You want your investments to grow, but sometimes that means you pay taxes. You don't want to pay taxes, but that might prevent you from investing in the right way. So you have to walk the line and understand the balance of, yes, we want our money to grow. Yes, we might have to pay some taxes, but we want to make those two decisions in tandem with each other that's going to net us out the largest benefit.
Got to have all the information, not just part of it.
Right.
Yep. Well, Harrison, thanks very much. We appreciate it, and have a good day, and we'll see you on Monday.
Thanks, guys.
All right. Again, that's Harrison Johnson. He is our financial planner. He is CFP at Wilsey Asset Management. He's a fee-based planner. He doesn't try to sell you any product, annuities, or anything else of that nature. He will sit down with you. If you want to do true tax planning, give him a call. That's what he does. He looks at the whole picture, not just the tax side. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004, or go to the website smartinvesting2000.com. Again, that's smartinvesting2000.com. All right. You want to talk about Leidos now?
Yeah, let's do it.
Leidos Holdings is the whole company name. Their symbol is LDOS. So they're in the information technology services. Short on the float side is only 2.4%, 81% institutional owned. A good start here. The PE ratio is 15.7 versus 56.9 for the industry. Price of sales 1.3 versus 0.6. Price of book value 4.5 versus 3.3. Price of cash flow is 13 versus 11.4. And they have a very good PEG ratio, 1.8 versus 10.2 for the industry. Now, you got some nice growth here. The earnings growth for Leidos of last year was 20.8%, and that's while the industry was down 34.2. Sales up by 3.1%, just slightly ahead of the industry growth of 2%. And the 5-year earnings per share growth estimate from the analyst is 8.1% for Leidos and only 6.2% for the industry. So Leidos looking pretty good so far. They do pay a 1% dividend. Use about 14.4% of the earnings to pay that out. We do send the balance sheet. They got a current ratio of 1.7, just above the industry at 1.6, so good liquidity there. Debt to equity is 1.1. That's the same as the industry, so not a bad debt situation. Do notice about 50% intangible assets, which is above the industry at 38.9. And got to be careful with those because those could be written down and cause you things that rate downs you didn't expect to come up because they were overpriced. We do see a net profit margin of 8.4 versus 7.3. Return on equity, very good, 29.5 versus 24. Free cash flow, $1.625 billion. Not as good as the industry at $5 billion, well, about $5.2 billion. So I'm a little bit disappointed there with Leidos on that one. Chase, what do you got?
Yeah, just kind of looking at this company. I mean, I've again seen them at the airport.
Are they a San Diego-based company?
No, they're in
used to be.
Virginia.
Oh, Virginia. Okay.
Yeah, so they're in Reston, Virginia.
Okay.
Is where they are headquartered. But again, I've seen them. They do the security detection essentially at the airports.
Yep.
You know, you walk in, you put your arms up, and it goes around you. That's Leidos. But I was kind of surprised by this. They have a lot of other different markets. I talked about aviation, but they also have defense, energy, government, health, homeland, intelligence, science, space. I mean, they have a lot of different things. It would really take some time to kind of break down exactly what this business does and kind of how's the revenue segmented into their various products and various industries. But again, it appears to be an interesting business serving several different markets, which is kind of nice. You have that diversification in case, things slow down and the airport business, maybe health can pick it up on the backside. So, appears to be an interesting company. Current price though for Leidos, ticker symbol LDOS, it's $175.10. 52-week range, the low here is $123.62 and the high $205.77. Going forward for the company now, we go out to December 2027. I see estimated earnings per share of $12.92 here. It gives us a target sell price of $214.47. So, I mean, that's I'm going to say a decent estimated gain of about 22-23% from the current level. Wouldn't be a buy for us just yet. We like a 30% margin of safety. But, I mean, I like what the business does. It's, frankly, looking at our portfolio, we don't have anything like this in our portfolio. I would say I'd be interested at the right price.
And I do see that there's like 12 analysts, and they're pretty tight. The low estimate is $12.50. The high is $13.50. It's just one of these companies that I want to say it's pretty safe. What could maybe happen with them is there's companies in the software industry, they're down 50%. Some of them don't deserve to be down that low, so maybe Leidos gets mixed in with somebody else that drops, and that could put them on sale.
Yeah, or you just have a market sell-off. You know, we're bound to have one of those at some point where you sell everything and ask questions later. I mean, that's generally the time you want to pick up quality, and you can find things at a good discount.
And be patient. Yeah. So Leidos, not a buy.
Not a buy yet.
Not a buy yet. Could be.
Yeah. If you held it, I'd probably continue to hold it.
Yeah. It's a good hold there at this point in time. Well, good. Let's talk about staying with the Economy Packaging Corporation of America. This is can I call it a cardboard company? Is that too simplistic?
It's corrugated boxes, if you recall.
I do remember we looked at a company like this. Maybe it was even this company. And it's so fun about investing is you learn so much. And these are some of the segments that I do on, Fox and KSI, is I talk about different things that sometimes are not with investing, but it's things we learn about companies. And if you're investing in companies and stock and you don't understand this stuff, you should not be investing because things can change very quickly. And we do a lot with the numbers, but you also have to understand the business as well.
Yeah. And I remember we looked at this several years ago, and you would think they would benefit maybe from like an Amazon type situation because we're using so many boxes. Well, obviously Amazon.
And box in a box many times, which is crazy.
And Amazon now, they use a lot of those poly bag sleeves, little ones, but they kind of focus more almost on promotional packaging. They work with a lot of like packaging for meat, fresh fruit, vegetables. So you go to the grocery store, you see those, boxes there. I mean, it's not necessarily the boxes that you envision when you go open the Amazon box. I think that is to a degree what they do, but it's not really where they generate most of their sales and income.
Well, and they are in the industry of packaging and containers, so kind of puts them there. Float is only about 4.7%, so people aren't expecting this to drop dramatically. It is almost 99% institutional owned. People don't hold this individually. They like the institutions to hold it. PE ratio, 27.1. Now, that is below the industry at 36.4, but still, I got to call it expensive. Price to sales, 2.3 versus 1. Price to book value, 4.4 versus 1.9. And then price to free cash flow, or price to cash flow, 14.5 versus 9.8. So again, expensive company based on the valuation ratios. You want them lower than the industry average. We do see a PEG ratio looking pretty good, 1.7 versus 10.7, so that's pretty good. The earnings over the last year, well, they're up 10.9%, almost double the industry at 5.9. Sales did increase by 4.6%, and this was not nearly as good as the industry. The industry sales growth was up 20.9% over last year. However, the analysts give a 5-year earnings per share growth estimate for packaging, PKG, Packaging Corp of America, of 12.9% going for the next 5 years, above the industry at 8.3%. So seems to be some good things going on there. Dividend, they pay a decent dividend, 2.2%, only use 50.3% their earnings to pay that out. Look at the balance sheet, got a current ratio of 3.2 versus 1.7, so a lot of liquidity there. That's a positive. Debt to equity, not bad, 0.9 versus 1.1. We do see a net profit margin of 10.2. That's well above the industry of 4.4, so that's a positive. Return on equity, 18.7 versus 5.7. Free cash flow is $725 million, not quite double the industry at $400 million. So I'm kind of liking on the balance sheet, looking pretty strong here, but we got to make sure that they're worth it based on the earnings.
Yeah, it was kind of interesting. This company in particular, and along with the other, packaging and pulp products makers, they did fall last Friday as I guess pricing for domestic container board declined to $20 a ton in February. So they got hit last February. They were around like $237. They dropped down to $220, but it regained a lot of that this week as Packaging Corporation of America in particular. They closed at $232.14 on Friday. 52-week range, though, the low $172.72 and the high $249.51. Unfortunately, you go forward for this company, you got to December 2027, estimated earnings per share here, $12.21. It gives a target sell price of $202.69, so below that current level of, again, $232.14.
We still seem to be in a situation where things are kind of expensive. We look and, we have seen some things pull back. Again, the software companies, I'll pick on them. Starting to see maybe technology come back a little bit. But it really has a long run to go. I mean, when you look at even this company, Home Depot, Costco, companies that are way overpriced, they seem to be hanging on.
Well, Costco, they like in particular, they didn't do well last year, but now they've kind of recouped some of the losses last year, and now they're trading around 50 times earnings again. I mean, it's just you have a lot of, I'm going to say, froth and expensiveness in this market, and it's not just in technology.
And I think people forget, like, well, I know Costco. I go there and I see it packed all the time. Yeah, that's part of the equation, but it always does come back to the numbers. Eventually, it's what you're paying for the earnings, and paying 50 times earnings. I always tell people, think about that. That means it would take you 50 years to make back what you pay in that stock based on those earnings. Now, yeah, the earnings will probably grow, but even with that, it still makes no sense.
Sorry, I over counted Costco. It's at 44 times future earnings.
Okay, 44, 50, about the same thing.
Yeah.
You know, you're still pretty high there. It's not like a 24.
And Walmart also, I mean, it's kind of gotten lumped in with what I'll call the safety trade, the defensive trade. It's like, oh, Costco, Walmart, we got to get out of tech and into, safe consumer defensive businesses. But yeah, Walmart's at about 38 times future earnings. These companies, in previous kind of market difficulties where we look at the tech boom and the subsequent bust, they did well during those time periods when things were kind of difficult for technology. But historically, they didn't trade at valuations in the 40s. I mean, that is just that's tough.
Yeah, I worry. Did I cut you off, or did you finish with?
Yeah, I finished.
Okay.
Yeah, it was a sell. It was overpriced.
Yeah, because I did look too at the earnings per share for December 2027. I think you said around $12.28. There's 7 analysts, and the range of those estimates are pretty wide. $10.67 the low, the high $13.67. So that's another thing too. It tells me that's not very strong. That they may not get that 12.28. They can miss that by a fair amount. So all these important things to look at, and people wonder, well, what do you do? Take you 10, 15 hours to look at a company. There's so many things to do, so many things to understand. That's why if you buy a stock and it's like you took we'll say a half hour to research it and then you bought it, you've missed a lot. You be prepared for a surprise down the road someday.
Yeah, and I will say there are some industries that you are going to have a wider range, and I'm not going to say that makes us like the stock more, but I mean, it makes sense, right? Like we'll go back to Leidos, like their input costs might be a little bit more straightforward, and I don't know the business through and through, but generally companies like that, your variable expenses aren't going to be as hard to predict out, where a company like Packaging Corporation of America, I mean, the container board and the pulp and everything else, you're going to have a lot more variability to those variable expenses. So it is harder for the analyst to give you a firm number because they're not even just projecting out necessarily how the sales are going to look and what the business lines are going to look like. It's now what is the variable cost going to be to that business. So I don't want to give it a pass in terms of the wide range of analysts, but a business like that, I think it is going to have more variability to the analyst estimates.
So many things to understand with it. That's why you look at many different factors there. But let's move on before we run out of time. Let's talk about Caesars Entertainment. I love their symbol, CZR. And I guess the Z is because they couldn't get an S maybe.
Yeah. I mean, I guess it sounds more like Caesar.
Yeah, that's true. I am shocked on the short on the float. It's 17.6%.
Wow.
So they're thinking that Caesars is going to have a hard time. I know you got some information, I think, on the earnings, so I'll save that for you when we get to it. But we do see that they have no PE ratio versus 26 for the industry. Price of sales 0.5 versus 1.4. That's a positive. Price of book value 1.5, half the industry at 3.1. And price of cash flow is 4 versus 7.3, so that's another positive. Now, the PEG ratio does look very good for Caesars. That's 0.7 versus 4 for the industry. Now, Caesars has no earnings over the past 12 months. The industry was up 36.9%. Sales for Caesars climbed by 2.1%, not as good as the industry growth of 6% there. Now, this is crazy to me. You see some bad things, and then you see the 5-year earnings per share estimated growth from the analysts, 178%. I don't think I've ever seen one that high versus 9.2% for the industry. So what do the analysts see that Caesars is going to grow their earnings in the next 5 years by a large amount? I think they're building things in China or something maybe, but I just, that's a hard one to kind of justify. And I'm disappointed. They do not pay a dividend. No yield there at all, so they don't pay a dividend. Balance sheet, current ratio 0.8 versus 1.4, so a little bit weak. Not a big concern at this point in time, but I'd say watch it. Debt to equity could have very low equity, but it's 7.1. The industry is 6.1, so something going on there. with the high debt to equity levels. Maybe these are just high debt companies with low equity companies there. Intangible assets, I got to point that out, it's very high, 45.6 versus 9.3, so a lot of intangible assets. We do see the net profit margin for Caesars is a negative 4.4%. The industry is a positive 5.4. Return on equity also a negative, unfortunately, 14.3 versus 28. And then free cash flow was 493 million, I think that would be, versus 897 million for the industry. So all over the board on this one. I'm not getting a good feel because I can't feel anything yet. It's just many different factors here.
Yeah, and I was kind of surprised by this. They do have other. Obviously, they have Caesars as their staple name, but it looks like they have a lot in Vegas. Actually, they operate Paris. Looks like Las Vegas.
Oh, Paris.
Planet Hollywood, the Cromwell. I know Nobu Hotel is kind of part of Caesars when you go in there. The Link, Harrah's, Las Vegas, Flamingo, and they're in Atlantic City. They're also in Reno, Arizona. They have Harrah's in California. We actually have the Harrah's in Southern California that is run by Caesars there. So it's not just the Caesars name. They have various other entities or establishments that they do run. But looking at the current price here for Caesars, again, their ticker symbol CZR, it's $25.05, and this stock's been interesting. I say interesting because year to date it's up about 7%, but over the last year it's down 25%.
Whoa.
Over the last 5 years, down 73%. Back in 2021, it was trading at close to $120 a share. So I mean, it's definitely been hit very hard.
And you saw the 10-year, right?
The 10-year, we have a 138% gain. So, I mean, it's...
I show 153% gain. I'm not sure.
Maybe they used to pay a small
didn't.
dividend,
Yeah.
and then maybe they cut it during COVID or something.
And again, it's another one. When Harrison was here, we're talking about the holding things too long.
Yeah.
I mean, I'm not sure when, but this should have not been held for 10 years.
I mean, if you would have hit its valuation, maybe not even at the top at 120,
Right.
but even 80, 90, we'll say, and you got out and paid taxes, you'd be better off than again still sitting at $25 a share.
Understand what you own.
Yeah, and going forward for the business, this is kind of coming back to your point about the earnings growth from the analysts. And it looks like in December 2027, they're estimating 75 cents per share. And I say, coming back to your point, in 2026, they're estimated to lose 3 cents. And there are less analysts in 2028, just 3 of them. Then they're estimating growth to $1.82. Just one analyst in 2029, but they're looking for $3.79. So there's something going on maybe with the accounting of this business that occurred that's allowing for very big earnings growth for Caesars. But if I use that 75 cents as that target earnings per share, we get a target sell price of just $12.45. So it is still expensive based off of those 2027 earnings. And kind of to your point, the range here is $11, or not $11, that'd be nice. 11 cents is the low and the high here, $1.79.
And what was your 2027 number?
75 cents.
Okay, because I show here for December 2027 $1.10 from 4 analysts, but the range is ridiculous. The low is 44 cents and the high is $1.79. So I don't
I have 11 analysts, so mine's going to be a little bit stronger of a number.
Yeah, you got much. Isn't it funny how different services can come up with different things that are so vast? And it doesn't happen very often.
Yeah.
But that's, again, why we don't just check one. We do look at 2 to try to come up with something. And, again, I like the 11 analysts better than the 4.
Yeah, and one thing that is interesting about Caesars business, but it could get hit, is the Caesars Digital. Their adjusted EBITDA, or I'm going to say kind of cash flow for simplicity, for the period came in at $85 million. That was compared with $20 million a year ago. And essentially that's going to be your kind of online sports book and online gambling. So Caesars has that platform. But again, that could get hit and it could hurt that future growth because we know prediction markets, I think, and the data has kind of shown it's stealing money from the online sports books.
And I think it will steal some, but not all. It's kind of like back, I don't know, during COVID, like, oh, it's over for the malls. No one's going to go to the malls any longer. And no, people like to go out and still shop and do stuff in person. I think the same thing here. You can gamble on your phone and very quickly, but it's still a lot of fun to go to the casino and have all the excitement and place the bets there and watch it on the big screen TV with everybody else. I mean, it's just something, entertainment.
Yeah, and it looks like Vegas is still doing well, but it has slowed or declined. I mean, There was some data that came out for January looking at gaming win on the Las Vegas Strip. It actually fell about 11% year over year. And what gaming win looks at is essentially the total of all cash and property received from the operators or the casinos versus what they paid out. So, I mean, to have an 11% decline, that could be a little bit of an indicator of revenue maybe slowing for some of these casino operators. I'm not sure how much they're doing in restaurants and shopping and the shows, but last time I went to Vegas, there were still plenty of people there. It's just, I think it got so crazy and so attractive that, we're kind of normalizing.
Yeah, and I would still like to compare the numbers. I know you don't have it, but compare the numbers to 2019, before the craziness of COVID started. Because what you had COVID happen, no one did anything, and then they
It's getting too hard to look at 2019. That was 7 years ago. Inflation's going to be too difficult to look at those numbers.
It's true, but you got to look at the whole numbers there. So there's a closing bell. Well, thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as an investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, as always, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. A lot of great educational information there. Sign up for the newsletter. Thanks for listening to the Smart Investing Show. We'll talk more next week right here on the Smart Investing Show with Brent and Chase.